love the channel and find it useful in becoming a happy retiree. Subscribe today. Lee joins us from Decatur. Lee, good morning. Welcome to Money Matters. What's going on? How can I help?
Yeah, I just wanted to know your opinion on closed-end funds at this time. I've got a couple of funds that are more fixed income with PIMCO and one with Guggenheim. They pay about 8 or 9%. With interest rates going up and the volatility in the market, is this a good time to still stay in the closed-end funds, or is it something I should be worried about maybe getting out of?
Sure. Closed-end funds, again, are a relatively complicated animal because they have equity-like movement and volatility, but even if it might be a bond closed-end fund. So closed-end fund, of course, for our listeners, is a basket of securities. It's actively managed, but they don't create new or take away shares. So there's a fixed number of shares, and that creates very often a tremendous disparity between the NAV, the net asset value, what the assets are really worth, relative to the price of the closed-end fund. If you look over the course of history, 85% of your rate of return has to do with how you buy these things. Do you buy them at discounts to their price? So the price to discount of a closed-end fund is just absolutely the key. Remember that because you're really looking at the underlying investments inside the closed-end fund, just like owning bonds right now is a little bit of a struggle because rates are going up, that can get exacerbated in a closed-end fund because a closed-end fund typically has some leverage. So yes, I would say you got to be really careful about the bond closed-end funds that you own because they probably use leverage. They obviously have really high distribution rates. It's different than a yield because it doesn't actually create an 8%. The bonds inside are not paying 8%. The closed-end fund itself is choosing to distribute out 8%. So there's also another really big disparity between the two. But yes, I would say that you got to be careful today using these leveraged bond closed-end funds because if bonds go badly in the next, let's say, year, then a leveraged closed-end fund that owns bonds will be even worse, maybe 2 to 3 times as bad. So yeah,
Fidelity had a screener where I could get. They actually recommended some lower leveraged closed-end funds. I think they were less than 25% leveraged. That'll obviously cut back on the risk?
Absolutely right. So in the world we live in today, on the bond side with closed-end funds, yes, you want to avoid leverage, not completely, but you want to have lower leveraged closed-end funds, and make sure that the underlying assets within are suited for the environment we're going into. I don't want to own long-term bonds today because rates are headed higher. I certainly don't want to own a closed-end fund with long-term bonds either because I think that problem gets exacerbated. So the key is it's continuing to buy these when they are at a discount to their NAV. That is the key. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.